Tonight's guest is someone I've really been looking forward to speaking with. Patricia McCoy is one of the country's top experts in housing and mortgage policy. But here's what makes her really unique. She's worked on the front lines of both academia and federal regulation. She's a professor at Boston College Law School, a former leader in the Consumer Financial Protection Bureau, not to mention a former official at the U.S. Treasury. Her work sits at the crossroads of finance and housing, as well as public policy. And few people are more qualified to help us understand where the housing market is going today. In other words, when it comes to housing, lending, and consumer protection, Patricia McCoy sees the whole chessboard. Thanks for joining us, Pat.
Thank you for that kind introduction.
You're very welcome, and it's much deserved. Tell the audience, tell our viewers a little bit about yourself.
Well, I was telling Mike before we started that I grew up in Kansas. My parents were both professors, and I remember my dad, he was very interested in showing me how the world worked. And so he would talk about all sorts of things, including how home mortgages worked. And then he would take me down to the local bank branch and talk with me about how banks worked. And I became interested in finance.
Interesting. So you were in Washington for a bit.
I was.
How did that shape your view of mortgages in the financial world?
The time I was in Washington was a very unique time, and it feels very different from today.
Okay.
I was there in 2010 and 2011, so 2 years after the 2008 financial crisis. And by 2010, Congress had passed major legislation to reform home mortgages.
Dodd-Frank?
That was the Dodd-Frank Act, and the Frank refers to our own Barney Frank here in Massachusetts.
Newton.
Exactly.
In Newton, actually.
Yes, exactly.
Yes.
Exactly. And so Congress, as one of the reforms it passed in Dodd-Frank, mandated the creation of a new Consumer Protection Bureau called the Consumer Financial Protection Bureau. And I had the great honor of my life to be asked to help be one of the people to stand it up. When I got to Washington, what I realized was that we had a unique opportunity to put mortgages on safe footing with the support of almost everybody. We had the support, obviously, of consumers, but we had it of the banking industry as well. Lenders are very supportive.
And I think that's, like you said, it's a unique situation because often there are two opposing forces when you have legislation like that.
That's right.
We'll get to Massachusetts in a moment, but I feel as though the MBTA Communities Act was similar in Massachusetts because the powers that are usually at odds, the developers and housing advocates both agreed on the MBTA Communities Act.
I've been on this earth long enough to realize sometimes the planets align, and sometimes parties who had been ardent opponents actually can agree and accomplish something, which means that even in our embattled political atmosphere these days, I retain some optimism that these moments will arise.
I agree with you. I too have faith in my countrymen that whatever the situation is, we will get through it.
For sure.
So tell me more about the 08 the '08 crisis and what caused it?
At the ground level,
Mm-hmm.
the lead up to the crisis was caused by a proliferation of reckless home mortgages.
Okay.
The federal government had deregulated mortgages,
Mm-hmm.
and that led to a race to the bottom.
Would you say that started in the 1980s?
No, I would say you saw the first glimmers of it in the 1990s.
Okay.
There were some. You're correct. There were some deregulatory changes that dated back to the 80s, but you needed more than that. You also needed new technologies that industry provided, and specifically new types of mortgages that we
Okay.
hadn't seen so commonly before. Those mortgages started to become more prevalent probably around 1998 or 99.
Okay.
But long story short, we were by 2002, 2004, we were in a situation where as many as half of mortgages were made on the basis of no proof needed of income, no proof needed that the applicant had a job.
I saw them.
I can imagine.
Loans for 110% of the value with the home.
That's right.
Just if you had a pulse, you could get a mortgage.
That's right. That's
Yes.
right. And it was a race to the bottom to get market share and to get any warm body through the door to sign up for a mortgage.
And then on the secondary mortgage market, they were all packaged
That's
and
right.
sold as securities or something?
They were sold as bonds.
Okay.
And you had investors pumping money into home mortgages, chasing yield. They were looking for high interest mortgages that they could invest in.
So after the crash of '08, what do you feel was done properly to correct it? And was there anything that we missed that regulators didn't quite go far enough with?
There were a lot of things that needed fixing, and we probably don't have time today to
Sure.
talk about all of them. But from my perspective, probably the most important change with respect to home mortgages was a provision in Dodd-Frank that basically said lenders have to make a good faith evaluation that the borrower can repay the loan, at least as of the date of the loan,
Correct.
and actually look at the borrower's income, look at the borrower's employment, or let's say Social Security and pension
history.
checks. Exactly. And properly underwrite the loan. As a result, our mortgage system, that's worked pretty well. Our mortgage system is much safer today. Ironically, lenders also like this because it creates a level playing field. So the reputable lenders can properly underwrite loans without worrying that unscrupulous competitors will undercut them.
Right. Right.
Because undercutting is
And
no
again,
longer
just like
legal.
you were saying, it's a race to the bottom. The lenders were undercutting each other and giving away mortgages like they were candy.
That's right.
Yes.
That's right.
Some people, and you see it a lot in social media and YouTube, shameless plug for my YouTube channel, Real Estate at the Spur of the Moment, but that we're set up for another '08 crisis. What would you say to that?
I would say yes and no.
Okay.
So today, I'm not worried about a housing bubble. And we'll talk about this a little bit later, but in fact, here in Massachusetts,
Mhm.
real estate values are softening, so they're certainly not inflating. But I am worried about some other pockets in the financial system. I'm worried about cryptocurrency.
Say a little bit more about that.
Cryptocurrency comes in two forms, but the form we're probably most familiar with is cryptocurrency such as Bitcoin.
Sure.
The value of Bitcoin is very volatile. It can go way up, it can go way down. In November, just a month ago,
And it's completely unregulated.
it's starting to be regulated.
Okay.
But you're right, it is quite unregulated. And it is very speculative. It also, unfortunately, can be a vector for criminal activity.
Of course.
So the volatility in crypto and the fact that it is subject to theft, it is subject to other types of criminal malfeasance, means that it's a very unstable market. So I worry about crypto. I worry about a newer type of lending to businesses called private credit
Okay.
that is being done by lenders that are not regulated banks. If private credit is extended by non-bank lenders that have very little regulation.
Would you say hard money? Is that what you're talking about? With
It's not necessarily hard money, but
Okay.
we're worried about the credit quality of the borrowers.
Okay.
And so private credit is another trouble area that I'm watching. And then finally, big tech.
Okay.
We've heard of the Magnificent Seven, the
Of course. Sure.
top 7 tech companies.
Sure.
And
I mean, some people say that those 7 companies are driving the economy right now, or at least the stock market.
The stock market.
Yes.
I'm very worried about that.
Okay. Say more about that.
We're not well diversified in the stock market right now.
Okay.
If ordinary Americans are advised, put your 401k retirement savings into broad-based index funds.
Okay.
But those indices, the Standard & Poor's 500,
Sure.
et cetera, are being driven by the profits of these 7 big tech companies.
Okay.
If those companies experience a decline, I fear that we're going to see a sharp decline in stock values as well.
Okay. Tell me about the difference between Wall Street and Main Street.
Wall Street, first of all, is the ground central for our financial system in the United States. It is obviously economically very powerful. It's also politically very powerful.
Okay.
And it is a locus of the wealthiest people in America. Then we have Main Street, which is just ordinary families, ordinarily people.
I would say to your book, I think it's the first chapter of Making the Ends Meet.
Right, exactly, exactly. These are ordinary families who are having a really hard time stretching their paycheck just to pay for basic necessities.
Correct.
And what we're seeing today is there is an enormous income gap between the richest billionaires in the United States, be they on Wall Street or elsewhere, and people on Main Street.
Correct.
That gap is growing. We also have a wealth gap. That gap is growing as well.
Would you say that that's been happening over the last 40 years?
Yes, absolutely, absolutely. And we've reached a point where we feel like the Gilded Age in the 1890s. The rich keep getting...
J.P. Morgan.
Exactly.
And Rockefeller. And yes. Okay.
Andrew Carnegie.
Carnegie, right. The robber barons.
That's right. That's right. We see the rich getting richer. The middle class not to mention lower income
Right.
people getting more and more stretched.
Yes. I think many families, many people that consider themselves middle class, would be put in jeopardy with $1,000 crisis. I mean, major car repair could really put them in serious bind.
The Fed asked a question like that in a survey a few years ago. It asked people, if you got hit with a $400 emergency expense, would you have either the cash or credit cards to pay for it? And 30% of people said no. Which means that it would be an absolute emergency for them.
Right.
Financial emergency.
That's a warning light going off.
It is. It is.
Really is.
It's a real flashing red light. We hear a lot of talk today about affordability.
Correct.
It is really spot on. People have a true affordability crisis, no matter what people inside the Beltway say.
Right.
And the other side of the coin of that is that about half of Americans don't make a living income.
Right.
What I mean by that is they can't even pay the rent and groceries and clothing and get through the month. We're not talking about streaming subscriptions or going out to dinner.
Or going on vacation.
That's right.
Or planning for retirement.
That's right.
Or saving for your kids' college. No, and housing is a big part of that.
Very much so. Everybody needs housing. It is an absolute necessity.
Let's talk about the current state of where housing is in the country right now. I feel as though we haven't built enough. There's not enough supply. After the crash of '08, just before that, we were building approximately 1.2, 1.3 million homes a year. After that crisis, after the '08 crisis, it dropped down to between 300,000 and 400,000 a year. Substantial drop. I believe that crisis washed out almost all of the small developers, the small builders, and for the next 10 to 12 years, it slowly crept back up. We need at least 1 million homes a year to keep up with the population.
Right.
So, depending on who you talk to, we're between 4 and 5 million homes behind.
Right.
So that's driving, economics 101 is supply and demand. I don't care what you have, if there's a high demand, the value of whatever it is, that widget, that product, is going to go up. So I think that, and that also goes back to zoning. We haven't really, for the last 40 years, we've built a McMansion or 2 townhouses, or the corporation put up 300-400 apartments. Those smaller, mid-sized buildings, 10, 20 units-ish, we haven't seen those being built.
No. We have a real problem with our zoning laws in the U.S. The zoning laws favor large lots. They discourage multifamily housing of the type you describe.
Sure, not in my backyard. I don't want to,
Yeah, people are saying, I don't want the traffic, I don't want the extra parking, I don't want the crowds. But the problem that we have is we're doing all of ourselves a disservice because if you look at my generation, we're now thinking about downsizing, but we either can't find...
There's no place for you to go.
That's right. We can't find the right place, or we can't afford it.
Right.
And that's just one demographic. Think about young families starting out. They would be well served by smaller homes or multifamily as a starter, as starter
Absolutely.
unit.
I'm a huge advocate for our business model is very much around investment property, rentals. We do property management and sales, and oftentimes we'll develop a relationship with a tenant. They're happy with the service we provide. They come back to us, hey, help me buy a home. I am a huge advocate for buying a multi because you're having someone else help you with your mortgage.
Right.
And it's an upward lateral move. It's not going from a multi to a single family. It's okay, well, it's you're moving up, but it's not such a big jump. And if you can hold on to that multi, it puts your kids through college.
That's right. Fascinating. When I moved to Boston, I was really intrigued with triple deckers.
Yes.
Which are the traditional multi if you go back 100 years in this area.
And I think you only find them in Boston and Providence. I don't think they're...
Yeah, I have lived in a lot of places all over the U.S., and I had never encountered them until I came to New England.
No, it's very much Boston.
Very much, and a great tradition because you can buy it, live on the ground floor unit, have that nice backyard.
Yep.
These are large buildings.
They are.
They're spacious, and then rent out the other 2 floors.
Right. We're seeing a lot demand go back to multis. I noticed this a few years ago when it was a property we were managing, very nice, very well done, renovated, and the owner decided to sell, and they were so nice that you'll probably get a better return if they sold as condos. We put them on as both multi and condo. The condo pitch, or we got a so-so response. When we advertised and did the open house as a multi, we had 3 offers, and it was 2 extended families.
Interesting.
So, you know, whether somebody has aging parents or kids that are coming back, there's a demand for that.
Yes.
There's a real demand for that now.
Yes. I'm not surprised, and there's a real need for it.
Massachusetts, I also think, is leading the way. I'm proud of Massachusetts for the MBTA Communities Act, but also the ADU law
Right.
that came in, accessory dwelling units. Single families throughout Massachusetts, by right, can have an ADU, a small in-law apartment, whether it's attached or unattached, for additional income, for an aging parent, or, you know, the son who comes back from college that decides, geez, should I go to graduate school or get a job? I'm not sure yet. So, what do you see moving forward with the mortgage industry? Are there any warning signs that you've seen? Are there any products that give you pause?
Well, there has been talk in the headlines recently about creating a 50-year mortgage.
Yes.
So
I've heard about that.
let me start with 50-year mortgages.
Please do.
The supposed rationale is that if you get a 50-year mortgage, your monthly payments would go down, and they would go down somewhat.
Sure, that monthly payment would decrease.
That's right. I don't want to overstate that. It's a modest decrease, but there's a problem.
The life of the loan.
The life of the loan means that anybody who takes out a 50-year mortgage will be paying interest for an additional 20 years compared to a 30-year fixed mortgage.
Sure.
And that could add up easily to $200,000 over the life of the loan if you live in the house.
I would be surprised if it was that low. My it's
and
probably much higher.
And you know, you're the one who's in the trenches.
Yes.
You run these numbers all the time. Exactly. Exactly. The other problem is one of the really nice things about a traditional mortgage is every time you make your monthly payment, you own a little bit more of the house.
Of course.
You
part
pay,
of it goes for interest and part of it goes principal.
right, exactly. So you're paying down the mortgage. With the 50-year mortgage, you're paying it down more slowly. So you build up your ownership stake much more slowly.
Right.
Most people are not going to live in the same house with the same mortgage for 50 years.
Correct.
At some point, they'll sell it. But with a 50-year mortgage, they'll find that the amount of equity they can pull out of the house is lower as a result.
Of course. Of course.
So it's not as effective in building wealth.
No, and I can't see a 50-year mortgage coming to fruition. Can you?
No.
No.
I don't.
I don't see, lending institutions or, seeing that as a viable product.
I agree.
What about transferable mortgages?
Transferable mortgages, portable mortgages,
Yes.
they're sometimes called, are, I think, a really intriguing idea. So the idea,
Okay.
Let me give a little background, if I
Sure.
may. Mike, you and I had talked about the fact that a lot of homeowners today were really smart when interest rates were rock bottom,
Right.
and they refinanced their mortgages into mortgages that might have been 2.75% a year
Right.
or 3% a year.
Yes.
Dream mortgage,
Yes.
dream
No,
rates.
Of course.
Now, if they're interested in moving, they're financially, it may be very hard to walk away from such a good
I
deal.
hear that so often in that, gee, I've got a 3-point-something mortgage. I'm not going to trade that in for 6-point-something.
Right.
Okay, we've got another child on the way. They can share a room for a couple of years. And that is also, there's trillions of dollars in equity that's not being put back into the system.
That's right. You were talking earlier about low supply of housing.
And that's part of it.
That's part of it as
Yes,
well.
it is. Absolutely.
People are not selling their homes as quickly as they used to because they want to hang on to these low-rate mortgages. So the idea of a portable mortgage is if you had one of these, let's say 2.75% mortgages, if you bought a new house, that mortgage would transfer over and finance the purchase of the new house. Let me mention, by the way, that I don't think these exist.
No,
it's
one thing if it's an assumable mortgage.
Right.
Because it's attached to the property.
That's right.
That's the collateral. So how can this instrument be changed so much with the change of a property?
That,
I don't see
that
how
is the rub. That is the rub. It's a really appealing idea. The problem is that most of our mortgages are sold to investors, and they're aggregated with other mortgages. They're bundled into pools that investors invest in. So it's very difficult to pull our particular loan out of the pool and make it portable. The investors will not want to invest in a portable mortgage because they invested in our mortgage based on our current house.
Exactly.
Not on some unknown future house that may not be in as good condition or
it was
maybe
based on the value of that property.
Yeah, that's right. The new place might be more of a flood risk than the current place. So the investors are very wary of the idea of portable mortgages, and I think that's the reason why they're not happening.
And both the 50-year mortgage and the portable mortgage, we're probably not going to see them anytime soon.
That's right.
I want to ask another question. In your book, you wrote a compelling question about foreclosure prevention. Talk about that for a moment.
Once somebody gets a mortgage and succeeds in buying a home, that's the beginning of the process. The next thing is we want to make sure that our homeowner has a successful experience owning the home.
Of course.
And so I've spent a lot of time thinking about how to try to make the home
Well,
ownership.
you were right in the thick of it in 2010.
I was.
That was,
I
yeah.
was, and you were in the thick of it as
That's
well,
true too.
Mike.
Yes,
From
I'm still in
from
therapy.
from your vantage as a realtor, you saw everything.
I did.
Part of it, obviously, is having a mortgage payment that
Mm-hmm.
is manageable. Part of it is having some savings. So one of the things I
Mm-hmm.
call for
Sure.
is help so that families can build up modest amounts of emergency savings. Even $1,000 makes a big
Yes.
difference.
Yes.
But in addition, sometimes life happens. Sometimes people lose their jobs. There's a death in the family. There's a
An
divorce.
illness. Yes. Or a
Exactly.
divorce. Something simple like that.
And all of a sudden, the homeowner's having trouble making the mortgage payment.
Mm-hmm.
Something I want our audience to know is that a major change
Mm-hmm.
since the 2008 financial crisis is now mortgage companies offer something called foreclosure prevention. Our technical term is loss mitigation,
Okay.
but basically, um, if somebody is having trouble making their mortgage
Mm-hmm.
payments, I urge them call your mortgage company as soon as possible. Don't
Don't wait until it's
and
snowballs.
right.
Yes.
Don't and don't avoid them. Call them because first of all, they can possibly give you a delay
Mm-hmm.
on your next deadline for submitting a mortgage payment. They might give you 3 or 4 months of
Mm-hmm.
breathing room to help you get back on your feet. If
Just that peace of mind,
yes,
just knowing that, okay, I've got some breathing room, makes a huge difference.
makes a huge difference.
Mm-hmm.
And there are a lot of homeowners for whom just 3 or 4 months is enough.
Yes.
Now, other homeowners have more long-term financial problems.
Right.
But once again, the mortgage company may be able to help out. They may be able to provide
Mm-hmm.
the homeowner with a loan modification that will actually cut the monthly payments.
Mm-hmm.
And we've seen a pretty good success rate with homeowners being able to stay in their homes
Mm-hmm.
with loan modifications.
And in my experience, lenders, they don't want to take the house back.
No,
They're not property managers. That's the last thing that they want to see, and it's in their best interest to work it out.
that's right. So something that was a real eye-opener was we were able to document
Mm-hmm.
coming out of 2008
Yep.
that if a lender went to foreclosure, they lost more money on the loan
Yes.
than most of the time working with the homeowner
Mm-hmm.
to do a loan modification
Yes.
or to do
That
forbearance.
doesn't surprise me at all. With my experience in real estate, just with whether it's an eviction from a tenant who's renting, you work with the tenant and get through a difficult situation as opposed to having this full-blown crisis, not only for the tenant, but the homeowner too.
Right.
And whether it's the homeowner and the lender,
That's
same
right.
thing.
That's right. And then on top of it, it pulls down the real estate values on the block.
Yes.
And we need to worry about that as well. So the federal government,
Mm-hmm.
after 2008, made a huge push to require mortgage companies
Mm-hmm.
to provide this type of relief. They can't do it every single time, but they do it.
Sure.
They do it the majority of the time. And I really encourage distressed homeowners
Mm-hmm.
to pick up the phone, call the
Be
mortgage company,
proactive.
and explore what relief is available to them.
Yeah. What's the worst that can happen? They can say no.
That's right.
Okay.
That's right.
And these types of programs and solutions that the government comes up with, it's so directly, a foreclosure affects every house on that street.
It does.
If 2 happen or 3, all of those property values are coming down. That has a huge impact on the whole neighborhood.
It can even cause a block to flip. You know, you have 2 or 3 vacant houses that are in foreclosure.
Yep.
You start worrying about crime, about squatters.
Yes.
And
Detroit has a huge problem.
absolutely. I remember looking at foreclosed properties in Cleveland, and squatters just suddenly came out of the house, which was
Yes.
which was a scary surprise.
No. Those situations aren't good for anybody.
No,
No.
no, they're not. Absolutely. And so we've made a lot of progress on that score. I will say there are some mortgage companies, technically in the industry we call them servicers,
Yes.
that are more disorganized than they should be. They have crossed wires. Sometimes,
And I've dealt with them.
yes, you've
Yes, I
you've
have.
seen them all.
Yes, I have.
And some of them do have an itchy finger and rush to foreclosure. But
Yes.
there are a lot that have really invested a lot to develop these relief programs and make them available.
That's great. How much influence do you think Washington really has on local housing markets?
I'm going to divide my answer into 2 parts. On mortgage financing, the federal government has a ton of influence.
Okay.
Today, the number 1 financier for home mortgages is
Must be
Washington.
Fannie Mae or Freddie Mac.
Yes,
Yeah.
yes, plus FHA mortgages. That's yes, exactly. So for mortgage finance, Washington calls most of the shots. Also for regulation of home mortgages, a lot of that regulation emanates out of Washington.
Sure.
And it has been successful regulation. The market works well with the regulation that we have now. On the other side, housing supply, Washington has a lot less influence. Now, I don't want to say that it has none. I just read today that the U.S. Department of Housing and Urban Development regulates the building codes for mobile homes and modular housing.
Okay.
So, you know, that's a small pocket where it has a lot of influence.
But you don't see much of that in urban areas, and
No.
that's where most of the population is.
That's
So it's
right.
going to have not as much impact there.
Yeah. The one place where the federal government might have impact on housing supply is tax incentives, which
Yes. Yep.
are large and are very influential. But zoning, housing supply, incentives for development, that's really a state and local
It
issue.
is. Yep.
And very much in our backyard.
And when I speak to clients, you'll see somebody at the post office. Oh, how's the real estate market? It's like, well, they'll say what they're seeing on TV or in the news and social media and whatnot. Oh, it's in a bubble, or it's this. It's like those may be macro views, or they're looking at the United States as a whole, and they're specifically talking about single-family homes.
Right.
The housing market or whatnot. Real estate is regional and local. And you've got to have your finger and understand those regional and local trends.
Right.
Our market is much more resilient. We don't see those high peaks and valleys. Florida is experiencing a very different housing market than we are in the Boston area.
Right.
Okay.
Right.
So it depends on who you talk to. Another question I want to ask is, do you see the mortgage interest deduction being removed from taxes?
I debate with myself about whether that's such a sacred cow that it can't be touched.
Many say it's a third rail.
I could see that, and it's interesting that so far we really haven't touched it. It is an inducement to people to buy homes, but it is for wealthier homeowners a type of government subsidy that probably is not justified.
I can understand that.
Right.
Yes.
But it is so valuable. It is so large to any particular homeowner. Makes a noticeable difference in lowering the homeowner's annual taxes.
Yes.
That people are going to fight to the death to preserve it.
Yes. No, that's a big one.
It is.
So,
It is.
Pat, I really want to thank you for being with us.
It's been absolute pleasure and so interesting.
There were several things we didn't get to go over that are in your book, but maybe you can come back and join us again.
I would enjoy that. Thank you.
And thank you for joining us.
Thank
We'll see you
you.
next time. So now we pretend like we're having a break. But I want you to sign my book.
Yes. Was this really half an hour?
Yes,
The time flew.
it does.
Incredible.
Yep. And I